Welcome back to the deep dive. I was standing in line for coffee this morning, and I was just fumbling through my wallet trying to find exact change because the card machine was down.
Yeah.
And I pulled out a 500 rupee note.
Always a good feeling to actually have cash on you these
Oh,
days.
right, exactly. But I stood there and I was looking at it, really looking at it while the barista was just waiting there. And it just struck me, this thing in my hand, it is literally just paper.
Just a blend of cotton and paper pulp, yeah.
Yeah, and technically it's not even that durable. Like if I leave it in my pocket and run it through the wash, it is completely done for. But I can hand this flimsy piece of paper to a total stranger, and they will give me coffee or gas or a book. It feels so tangible. It feels like wealth.
This is a very, very convincing illusion, isn't it?
It is. But the more we dug into the research for today's deep dive, the more I realized that the money in my pocket isn't really an object at all. It's the end result of this massive invisible system of levers and pulleys, and it's all controlled by one giant entity.
The central bank.
Exactly. And what happens when that entity decides to turn a dial just a fraction of an inch to the left? Well, the price of my coffee changes, my home loan interest rate changes, the entire country shifts. It is a butterfly effect, but completely engineered.
It's a bit of a matrix moment when you finally realize that. We tend to think of money as static, right?
Yeah.
Like a rock. We just trade back and forth. But it is actually a flow. It's a current that's regulated by a very specific engineer. And understanding that engineer of the Reserve Bank of India is probably the single most important step in understanding the entire Indian economy.
The engineer behind the curtain. I love that. And before we jump into the engine room of the economy, we do have a very special message for all of you listening today. This full summary deep dive is specifically focused on the UPSC curriculum, and it's brought to you by the Simplified UPSC by PPP YouTube channel.
Yes, and we have a really humble request for everyone tuning in. If you find value in this deep dive, if it helps you connect those difficult dots between the theory and the reality of the economy, please subscribe to the channel. It really helps improve retention, and it ensures the team can keep producing this.
Absolutely. And for those of you who are capable, please consider supporting the team on Patreon. It allows them to keep bringing this super useful content to you week after week.
And a huge warm shout out to all the current supporters. You help immensely in creating this content. We couldn't do it without you.
Definitely. And hey, don't forget to like the video and share your valuable comments. We want to hear from you. Also, quick resource alert for the students out there. Free notes with practice PYQs. That's previous year questions are available right now on the public Telegram channel. You can just DM to join.
And for the really serious learners, there is a private Telegram library available too. That gives you access to all the videos in the series at once. Plus, organized premium notes, detailed notes, extra PYQs, and even model mains answers.
It is an absolute gold mine for mains prep. Just DM on the public Telegram channel to get access to that private library. Okay, let's unpack today's topic. We are doing a deep dive into the Reserve Bank of India and the Monetary Policy Committee, or MPC.
A true heavyweight topic. Honestly, perhaps the heaviest in the entire syllabus.
The absolute heaviest. And to guide us, we are using a stack of incredible sources. The backbone of our discussion today is Chapter 14 of Sanjeev Verma's Indian Economy.
A classic.
Yes, but because we want total conceptual clarity for you guys, we are cross-referencing and layering in some really deep insights from Vivek Singh's Indian Economy, specifically Chapters 2 and 3.
Yeah, Vivek Singh's work is particularly good for understanding the technical nuances. Things like the balance sheet of the RBI, which a lot of people just overlook, but it's crucial for answering those tricky prelims questions.
Precisely. And we aren't stopping there. We are also analyzing actual UPSC previous year questions to see how these concepts are tested in reality. Our mission today is to move way beyond the dry textbook definition of a central bank. We want to understand how liquidity is actually managed, how inflation is tamed, and why the money multiplier might just be the most magical and misunderstood concept in all of banking.
It certainly is one of the most frequently tested concepts, so we really need to nail it. Shall we start at the very top?
Let's do it. Section 1, the apex institution. So Sanjeev Verma calls the RBI the apex bank. And that sounds impressive, right? Almost like an apex predator at the top of the food chain. But what does it actually mean in the context of history? Because the RBI wasn't always this giant government entity we know today, was it?
No, it wasn't, and that's a super common misconception. If we look at the historical context that Vivek Singh provides, the RBI actually started out as a private shareholders bank.
Really?
Yeah, it wasn't born as a state entity at all. It was set up based on the recommendations of the Hilton Young Commission way back in the colonial era. The legislation that birthed it was the Reserve Bank of India Act of 1934, and it officially commenced operations on April 1st, 1935.
April Fool's Day.
Ironically, yes, but the key takeaway for you listening is its evolution. It started with private ownership, but the very nature of a central bank requires it to be perfectly aligned with national interests. You can't have private shareholders dictating national monetary policy. So it wasn't until 1949, just after independence, that it was officially nationalized.
Okay, so when we call it the apex bank or the captain of the banking ship, we're referring to its evolution into the supreme monetary and banking authority. It went from private hands to being fully 100% owned by the government of India.
Exactly. It creates and enforces the rules of the game now.
Now, Sanjeev Verma draws an interesting distinction right at the beginning of his chapter between money and near money. And I feel like this is a concept we often glaze over, but it's crucial for understanding liquidity, right?
It is completely fundamental. Think about money in the strictest sense. It has universal acceptability. It is a medium of exchange and a store of value. The currency notes in your pocket, that is money. It is legal tender.
Meaning you can't refuse it.
Right. You can go to a chai shop in Kerala or a bookstore in Delhi or a taxi in Kolkata, and they have to take it. It settles debt instantly and legally.
It's the ultimate liquid asset. Zero friction.
Near money, on the other hand, functions like money, but it lacks that immediate universal legal tender status. Think of things like credit cards, demand drafts, or even treasury bills.
Okay, so they have value.
Oh, absolutely. You have value there. You are very rich if you have a massive stack of treasury bills. But you can't just walk into that chai shop and easily pay for a 10 rupee tea with a 10,000 rupee treasury bill. It's near money because it requires a step of conversion or a specific acceptance that just isn't as automatic as handing over cash.
That makes total sense. It's all about the speed of liquidity. How fast can I turn this financial instrument into a cup of coffee? Cash is instant. A treasury bill takes a few steps. Now let's get into the weeds a bit because this next part blew my mind. Vivek Singh has this fantastic section on the balance sheet of the RBI.
Yes. The balance sheet is where things get really interesting.
Because for a lot of people, myself included, the idea that the money in our pocket is a liability for the RBI is super confusing. If I have a 500 rupee note, isn't that an asset? It certainly feels like an asset to me.
For you, the hold, it is absolutely an asset. It represents your purchasing power. But you have to flip your perspective and look at it from the issuer's perspective, the RBI's perspective.
Yeah.
Have you ever actually read the small text on a currency note?
I have, actually. It says, I promise to pay the bearer the sum of 500 rupees. And it's signed by the RBI governor.
Exactly right there. That phrase, I promise to pay, makes that note a literal promissory note. It is a debt instrument. The RBI is promising you that this piece of paper holds purchasing power equal to 500 rupees. And because it's a liability, the RBI must back it up with assets.
Because it's basic accounting.
Right. You cannot have a liability on a balance sheet without a corresponding asset to balance it out. Section 33 of the RBI Act legally requires that every single note issued must be backed by assets. Specifically, they use gold government securities and foreign currency assets.
So they can't just run the printing press and make money out of thin air just for fun. They need actual assets to balance that new liability.
Precisely. If they print more notes, which increases their liability side, they must acquire more assets like buying gold or dollars or government bonds to balance the sheet.
Which brings us to a term that I found in the Vivek Singh text that honestly sounds like something from a medieval fantasy novel. Seigniorage.
Ah, yes, seigniorage. It is a lovely archaic term for a very practical and honestly somewhat controversial concept. It effectively refers to the profit a government makes from money creation.
Profit from making money. That sounds like a cheat code in a video game, like an infinite money glitch.
It kind of feels like one, doesn't it? Think about it practically. What is the actual physical cost of printing a 500 rupee note? The paper, the security thread, the special ink, the labor. It's maybe, what, 3 or 4 rupees?
Oh, not much, yeah.
But its face value, what it buys in the real market, is 500. The difference between that face value and the actual cost of production is a profit. That is seigniorage, and it accrues to the RBI.
That is a staggering margin. I mean, if I could sell a product that cost me 4 rupees to make for 500 rupees, I'd be the richest person in the world.
Indeed you would. But Vivek Singh explains it's not just the printing cost difference, it goes much deeper than that. Remember that balance sheet we just discussed?
Right, the liabilities and assets.
The RBI issues currency, which is a liability. But crucially, it pays 0 interest on that currency. You don't get a monthly interest payment from the RBI just for keeping a 500 rupee note in your wallet, right?
Oh, sadly, no.
But the RBI uses that zero-interest liability to buy assets like government bonds or U.S. Treasury bills that do pay interest.
Oh, I see. So effectively, by holding cash, the public is giving the RBI a massive interest-free loan, which the RBI then takes and invests to earn interest for itself.
That is exactly it. That interest income contributes heavily to the RBI's massive annual profits. That is the true power of seigniorage. It's the income derived from the sovereign monopoly power of issuing currency.
Okay, that is fascinating and mildly infuriating. I need to get all my cash into a savings account immediately. Holding physical cash is basically losing out on the game while the RBI rakes in the interest.
From a purely rational economic standpoint, yes, you shouldn't hoard cash.
Moving on to Section 2, the core functions of the RBI. We know they print money, but they wear so many other hats. Sanjeev Verma lists banker to the government as a primary role.
Yes. The RBI manages the day-to-day accounts for both the central and state governments. It receives their revenue like all the taxes we pay, and it makes their payments like salaries and funding for various schemes. But there's a very critical concept here for exams called Ways and Means Advances, or WMA.
WMA, this acronym comes up a lot in the business news. This is basically a loan facility, right?
It is a loan, but the nuance is what gets tested. WMA is a facility strictly for temporary mismatches in receipts and payments.
What does a mismatch look like in practice?
Let's say the government has a massive salary payout due today. Millions of government employees need their paychecks clearing. But the GST tax revenue that funds those checks is only hitting the government accounts next week. They have a cash flow gap. They can take a short-term loan from the RBI via this WMA facility to bridge that specific gap.
So it's basically an overdraft facility. Like if I authorize my rent payment a few days before my actual paycheck hits my bank account?
Exactly. It's an overdraft. But this is a huge, but for UPSC aspirants, it is not a source of funding for the fiscal deficit.
Wait, let's unpack that difference because it sounds subtle. Why does that distinction matter so much?
Because this is a crucial piece of Indian economic history. In the past, specifically before 1997, the government used to issue what were called ad hoc treasury bills. If they ran out of money because they overspent their budget, they would just issue these bills, the RBI would automatically buy them, and voila, new money was printed to fund the government's spending.
They just printed money to cover their debts. That is called monetization of the deficit, right?
Yes, automatic monetization. And it was an absolute disaster for inflation.
Because you're just dumping new money into the system without creating any new goods or services.
Exactly. You had more and more money chasing the exact same amount of goods, so prices skyrocketed. So in 1997, they officially signed an agreement to stop that practice. Now, WMA is strictly temporary, usually has to be repaid within 90 days, and the government is charged interest at the repo rate. It forces the government to be much more fiscally disciplined. They cannot just treat the RBI as an endless magical piggy bank to fund their deficits anymore.
Got it. So WMA is for cash flow smoothing, not for long-term spending. Now, the next major function is banker to banks. And I see a PYQ reference here from 2012.
Yes, the 2012 question asks what it implies when we say the RBI acts as a banker's bank. The correct answer covered three main things. One, banks keep their statutory deposits, like CRR, with the RBI. Two, the RBI lends to banks in times of need. And three, the RBI advises banks on monetary and financial matters.
That second point, lending in times of need, is often referred to as being the lender of last resort. Vivek Singh uses the bank run scenario to explain this, which is basically that famous scene from Mary Poppins, right? Where everyone is screaming for their money at the teller.
It's the classic banking nightmare scenario. Imagine a rumor starts on WhatsApp that a specific bank is failing. Maybe it's true. Maybe it's totally fake. But panic sets in, and everyone rushes to the branch to withdraw their money all at once. Now, does a bank keep all your deposited money sitting in a vault?
No, of course not. They've lent it out for home loans and car loans and building factories.
Correct. So they have the assets, the loans they've made are valuable assets, but they are tied up for years. They do not have the liquid cash on hand to pay everyone today. So they are solvent, meaning their assets are technically greater than their liabilities, but they are highly illiquid.
And in the middle of a panic, no other regular bank is going to lend them cash because everyone is scared.
Exactly. The interbank market freezes up.
Yeah.
That's exactly when the RBI steps in as the lender of last resort. It provides emergency liquidity, actual cash to these solvent but illiquid banks to pay off the panicked depositors and prevent the panic from spreading to other banks. It ensures the whole system doesn't collapse just because of a temporary psychological cash crunch.
It's the ultimate backstop, the safety net that keeps the whole house of cards standing. Now, a quick trivia point from the issuer of currency function. We know the RBI prints the notes, but does it print all the currency in India?
Not all of it, no. The government of India, specifically the Ministry of Finance, mints all the coins and they print the 1 rupee note.
The 1 rupee note. Man, I haven't seen one of those in ages.
They are quite rare in circulation now, but legally they are distinct. That is exactly why, if you look closely, the 1 rupee note is signed by the finance secretary, not the RBI governor. Everything else, from the 2 rupee note upwards, is strictly RBI territory.
I love those little details. It's those tiny exceptions that almost always show up in the prelims. Okay, last major function before we hit the actual policy toolkit. Manager of foreign exchange.
This connects directly to the external sector. The RBI acts as the custodian of the country's entire foreign exchange reserves. But the crucial point for exams referencing the PYQs from 2019 and 2022 is how they manage the rupee's value globally.
It's called a managed float rate, as opposed to a fixed exchange rate.
Yes, the RBI does not fix the rate. They don't just declare $1 equals 80 rupees and hold it there artificially with an iron fist. The free market decides the day-to-day rate based on supply and demand. But the RBI hates volatility. They don't want the rupee crashing or spiking wildly overnight because that completely kills business planning for importers and exporters.
So what do they actually do? How do they manage it if they aren't fixing it?
Let's say the rupee is depreciating really rapidly, losing value against the dollar. That means there is too much demand for dollars in the market. People are selling rupees to buy dollars. The RBI will step in and start selling dollars from its massive reserves into the market to satisfy that demand. By supplying dollars, they prop up the value of the rupee.
Okay, and what if the reverse happens? Like if foreign investment is just flooding into the Indian stock market and the rupee is appreciating too fast?
Then the RBI buys dollars from the market. They take the dollars and inject rupees. This keeps the rupee from getting too strong, which is important to keep our exports globally competitive. They're essentially acting like a giant shock absorber, smoothing out the bumps on the road. They don't change the direction the road is turning, but they make the ride much smoother for the economy.
Okay, let's move to Section 3. Liquidity Management, the toolkit. This is the absolute meat and potatoes of monetary policy. The fundamental problem is simple, right? Too much money equals inflation. Too little money stifles economic growth. How does the RBI turn the dials to fix this?
They rely on quantitative tools, the big guns of monetary policy. The first and most blunt instrument is CRR, or cash reserve ratio.
Let's define it clearly for everyone. What exactly is the CRR?
CRR is a specific percentage of a bank's total deposits. The technical term for UPSC is net demand and time liabilities, or ADTL, that the bank absolutely must park with the RBI in the form of physical cash. It is entirely non-negotiable.
And does the RBI pay the bank's interest on this massive pile of cash?
No. Sanjeev Verma is very clear on this point. Banks earn zero interest on the CRR. It is a dead asset for them. It just sits in an account doing absolutely nothing.
Ouch. That's got to hurt their profit margins. So why does the RBI do it? Why force banks to keep billions in dead money?
For 2 main reasons. One is safety. It ensures banks always have a mandatory cash buffer in case of unexpected withdrawals. 2, and much more importantly for monetary policy, it's a direct, instantaneous drain on liquidity. If the RBI decides to raise the CRR from, say, 4% to 5%, billions of rupees are instantly sucked out of the commercial banking system and locked away in the RBI's vault.
Meaning those banks suddenly have significantly less money to lend to businesses and consumers.
Exactly. And less money available to lend means higher interest rates on the remaining money. Borrowing gets expensive, people stop spending, and that cools down an overheating economy. It is brutally effective.
Then we have the other reserve ratio, SLR, or statutory liquidity ratio. How is this fundamentally different from CRR?
SLR is the portion of deposits banks must keep aside before they can lend, but they keep it with themselves, not the RBI. And the key difference is the form it takes. They don't have to keep it in pure cash. They can keep it in approved liquid assets like gold, or crucially, government securities known as GSECs.
And unlike cash, GSECs earn interest.
Exactly. So banks don't mind the SLR nearly as much as the CRR. But from the government's perspective, SLR is brilliant because it provides a captive market for government borrowing. If the government needs to borrow money to build highways, they know the banks legally have to buy these government securities to meet their SLR targets. It ensures the government always has a willing lender.
There was a really good PYQ in 2015 about this. The question simply asked, if RBI reduces the SLR, what happens?
Right, so if you reduce the mandatory holding, percentage banks have more free funds. They aren't forced to buy as many government bonds, So the logical implication is that banks now have more liquidity available to lend to the private sector, to you and me. This could lead to lower lending rates and more private credit growth. It unlocks capital for the real economy.
Right. Now let's talk about the tool that acts like a giant sponge. OMO, or open market operations.
I really love the sponge analogy. It simplifies a complex mechanism perfectly. FOMO is basically the buying and selling of government securities by the RBI in the open market.
So imagine the entire economy is a bucket of water, and the water is liquidity, but they should at their own.
Right. So if the RBI wants to remove water, let's say, to fight high inflation, it takes its sponge and it sells government securities to the banks. When the banks buy these securities, they pay the RBI, so money leaves the commercial banks' accounts and goes into the RBI. The sponge soaks up the water. That money is effectively gone from circulation.
And to add water back in, say there's a recession and they need to stimulate the economy.
Then the RBI buys those securities back from the banks. The RBI takes the paper bond and hands the banks fresh cash. It essentially squeezes the sponge back into the bucket. Suddenly, banks are flush with cash and they start lending aggressively.
Simple and visual. The PYQs in 2013 and 2020 touched exactly on this, confirming that the purchase of securities by the central bank constitutes a direct increase in money supply. It's a direct injection. Now let's get to the alphabet soup that dominates the news. LAF, or Liquidity Adjustment Facility. Repo and reverse repo. These are the headline grabbers every time the RBI meets.
Yes, this is how the RBI manages day-to-day short-term liquidity. The repo rate is the main one. It is the policy rate. It's the interest rate at which commercial banks borrow short-term money from the RBI. And they have to provide collateral, usually GSECs, to get this loan.
So if the repo rate goes up, borrowing becomes more expensive for the banks.
Yes. And ideally, the banks pass that increased cost straight to you. Your floating home loan interest rate goes up, your car loan EMI goes up. As borrowing gets more expensive across the board, you borrow less, spending drops, demand across the economy drops, and finally inflation drops. That whole chain reaction is called the transmission mechanism.
But sometimes that transmission is pretty sluggish, right? Like banks are super quick to raise rates on our loans when the repo goes up, but they seem awfully slow to raise the interest rates they pay us on our savings deposits.
That is a perennial and very valid complaint from consumers. But the mechanism itself is sound in economic theory. If the wholesale cost of funds rises, the retail price of loans must eventually rise.
And reverse repo.
That's just the opposite flow. It's the interest rate banks earn if they park their excess surplus money with the RBI.
Now, Vivek Singh brings up this really interesting concept called the corridor. Can you explain that? I find visualizing it really helps cement the idea.
Sure. Think of it as a hallway or a tunnel. The corridor defines the absolute boundaries of short-term interest rates in the money market. The RBI wants the actual market interest rate, what banks charge each other, to stay securely within this tunnel. At the very bottom, the floor of the corridor, we use reverse repo. But recently, we shifted to the SDF, or Standing Deposit Facility.
SDF, that's a relatively new addition to the toolkit, right?
It is. It was introduced to allow banks to park massive amounts of excess cash with the RBI without the RBI needing to provide government securities as collateral. It absorbs liquidity much more efficiently when the system is flooded with cash. That's the floor. The market interest rate shouldn't drop below the SDF rate because realistically, why would any bank lend to another risky private bank for less interest than they can get completely risk-free from the RBI?
That makes perfect sense. So SDF is the floor, and in the middle of the tunnel is the repo rate.
Right, the repo rate is the target, the anchor.
And at the top, the ceiling of the corridor.
That is the MSF, or Marginal Standing Facility. This is a penal higher interest rate for emergency overnight borrowing. If banks run out of their normal borrowing limits under the repo window, they can dip into the MSF, but it's going to cost them more.
So the day-to-day rates naturally fluctuate within this defined corridor. SDF acting as the floor, MSF acting as the ceiling.
Precisely. It keeps the interbank interest rates highly stable. If rates hit the ceiling, banks just borrow from the RBI. If rates hit the floor, banks just deposit with the RBI. It keeps the whole system contained and predictable.
Okay, let's dive into Section 4. And honestly, this is the part that usually blows people's minds the first time they learn it, the money multiplier.
Oh, this is a huge favorite for UPSC paper setters. It appeared in both 2019 and 2021. It explains how the commercial banking system itself actually creates money. It is a huge myth that only the RBI creates money by printing notes. In fact, the vast majority of money in our modern economy is created by commercial banks through lending.
Please explain the magic here. Because if I deposit 100 physical rupees in my account, how does that somehow become More money. It sounds like literal alchemy.
It does, but it's just the mechanics of fractional reserve banking. Let's trace that exact 100 rupees. You deposit 100 in cash into Bank A. Now, let's say the total reserve ratio combining CRR and SLR is 10%. The bank legally keeps 10 rupees in the vault as the fraction and is free to lend the remaining 90 rupees to a local business.
Okay, stop there for a second. So right now I log into my banking app and I still see a balance of 100 rupees. I feel like I have 100. But that business just walked out the door with 90 rupees in actual cash.
Right. So already the system feels larger. Now the business takes that 90 rupees and uses it to pay a supplier for raw materials. The supplier takes that 90 rupees and deposits it into their own bank. Let's call it Bank B. Now, Bank B has a brand new deposit of 90. They apply the same 10% rule. They keep 9 rupees in reserve, and they lend out 81 rupees to someone else entirely.
Wow, okay, so now we have my original 100 showing on my app, plus the supplier has 90 showing on their app, plus the next person has a loan of 81. The initial single 100 rupee note is literally multiplying as it moves.
Exactly. The total deposits, the digital money in the system, are growing exponentially, even though the physical cash, the actual printed base money, remains exactly the same. The mathematical formula for this one is simply money multiplier equals 1 divided by the reserve ratio. If the reserve ratio is 10%, which is 0.10, the multiplier is 10. That means your single 100 rupees of physical cash can support up to 1,000 rupees of total money supply in the broader economy.
That is wild. It really shows how credit, just the act of lending, drives the entire modern economy. Now, the PYQ in 2019 asked a very specific conceptual question: which of the following increases the money multiplier?
Yes, the options were things like increasing the CRR, increasing the population, but the correct answer was an increase in the banking habits of the population.
And why is that the answer? Because on the surface, that sounds more sociological than economic.
It does, but think about the chain we just described. The multiplier only works if the money continually comes back into the banking system. Let's say the business pays the supplier in cash, and the supplier, instead of depositing it in Bank B, just hides the cash under their mattress or in a jar in the kitchen. The chain breaks instantly. Bank B never gets the new deposit, the subsequent lending stops, the multiplier dies right there.
Oh, I see. So hoarding cash kills the multiplier effect. Using banks actively fuels it. That's a brilliant insight. And honestly, it explains exactly why the government pushes for financial inclusion so hard with schemes like Yantan Yohana. Getting everyone a bank account isn't just about welfare, it's about increasing the money multiplier to boost the whole economy.
It is entirely macroeconomic. It also connects perfectly to the money supply aggregates that Sanjeev Verma details.
Yeah.
M1 is the most liquid form, just currency plus demand deposits. But M3, which is called broad money, includes time deposits like fixed deposits. M3 is the metric that captures the full extended extent of this multiplier effect, which is exactly why the RBI tracks M3 so incredibly closely to gauge the total actual money floating in the system.
Got it. Now let's shift gears from the mechanics to the people actually making these massive decisions. Section 5, the Monetary Policy Committee, or the MPC.
This represents a massive institutional shift that happened in 2016. Before this, the RBI governor was basically a king when it came to monetary policy. He had a technical advisory committee, sure, but he could completely veto them. It was a one-man show.
And what changed in 2016?
It shifted to a committee-based approach. Following the Urjit Patel Committee recommendations, the goal was to introduce transparency and a formal legal adoption of what we call inflation targeting. It moved the system from a discretionary individual decision to a rules-based institutional consensus.
Let's break down the actual structure of this committee. Who is in the room?
It's a 6-member team. 3 members represent the RBI. That includes the governor, a deputy governor, and 1 other senior official. And the other 3 members are external experts, usually prominent economists appointed directly by the government.
That sounds like a perfectly balanced scale, 3 and 3. But who actually wins in a tie? Like, what if the government appointees vote one way wanting to cut rates and the RBI people vote the other way wanting to raise them?
Well, each of the 6 members has 1 equal vote. But if there is a deadlocked 3-3 tie, the RBI governor holds the casting vote to break the tie. So structurally, the RBI still holds the ultimate edge, but it forces a process of consensus building. The governor can't just ignore everyone anymore. He has to actively convince at least 2 others to avoid a contentious tiebreaker situation.
What is their core job? I mean, they have one specific legal mandate, right?
Yes. Their primary legal mandate is to maintain retail inflation measured by the Consumer Price Index, or CPI, at exactly 4%. But they are given a tolerance band of plus or minus 2%.
So anywhere between 2% and 6% is considered the safe, acceptable zone?
Correct. He gives them necessary flexibility. If global oil prices spike suddenly, inflation in India might jump to 5 or 5.5%. That's okay, it's within the band. But if inflation stays above 6% or drops below 2% for 3 consecutive quarters, it is legally considered a failure of the committee.
And what happens if they fail? Do they all get fired?
Not fired, no, but they are heavily held accountable. If they fail, the RBI must write a formal public report to the government explaining exactly why they failed, what remedial actions they propose, and an estimated time frame to get inflation back into the band. This level of accountability never existed before 2016. It forces them to clearly explain their logic. It makes them answerable to the public.
And what about transparency for the markets? How do we know what they debated?
They are legally required to publish the detailed minutes of the meeting 14 days after it concludes. We get to see exactly how each individual member voted and their written justification for that vote. The market analysts scrutinize this. We know exactly who the hawks are, the ones fighting inflation, and who the doves are, the ones prioritizing growth. No more black box decisions.
That is a massive improvement for market predictability. But talking about the government appointing members naturally brings us to Section 6, RBI Autonomy and Conflict.
This is often the juiciest part of financial journalism. Vivek Singh describes the relationship as a fundamentally difficult marriage. On one side, you have the government, which acts as the spender. They control fiscal policy. They want to win elections. They need to build infrastructure, hand out subsidies, create jobs. So they generally always want low interest rates because that means cheap borrowing and faster economic growth.
And the RBI on the other side.
The RBI is the money creator managing monetary policy. They are inherently conservative. They are worried about the long-term purchasing power of the rupee. They want to control inflation above all else. And controlling inflation often means maintaining higher interest rates. It's like taking away the punch bowl just as the party is really getting going.
So naturally, they're going to clash. One side always wants to step on the gas, and the other side always wants to keep a foot hovering over the brakes.
It is a deep structural conflict baked into the system, and it boils over into the public eye sometimes. Which means we have to talk about Section 7 of the RBI Act.
Ah, yes, the nuclear option. That just sounds ominous.
It is ominous. Section 7 essentially empowers the central government to issue binding directions to the RBI in quote-unquote public interest. It effectively says that in extreme cases, the government can legally order the RBI to do what it wants.
Has that ever actually been used?
Historically, no, never. It was always considered a taboo, an absolute last resort. The very threat of using it implies a complete breakdown in the relationship. But in recent years, it was heavily in the news because the government formally started consultations under this section, which caused a lot of friction.
Why? What were they fighting about so fiercely?
One of the major flashpoints was the economic capital framework. Basically, the RBI over decades sits on a massive mountain of reserves. These are profits from that seigniorage we talked about earlier, plus the revaluation of their gold and forex assets. The government basically argued, hey, you're sitting on way too much idle cash. Give some of that surplus dividend to us so we can stimulate the economy and fund our deficit.
And the RBI's defense?
The RBI argued strongly that we need this massive cash hoard as a safety buffer for national financial stability. What if there's another 2008-style global crisis? We need ammunition to defend the economy.
So it became a standoff. How did they resolve it? I know they formed the Bimal-Jalan Committee to settle the dispute.
Exactly. The government appointed the Bimal-Jalan Committee to look at global best practices. The committee eventually decided on a strict mathematical formula, a specific percentage range of buffer the RBI must legally keep. Anything realized above that specific buffer can and should be transferred to the government as a dividend. It was a very elegant way to institutionalize the transfer and stop the political fighting. It permanently set the rules of engagement.
It's literally like a prenup for the central bank and the government.
That is a very apt analogy. Vivek Singh quotes past legendary governors like D. Subbarao and Y.V. Reddy, who beautifully summarized this delicate autonomy. They say the RBI is independent, but within the framework of the government. It is not a separate fourth branch of the state. It is ultimately accountable to the people through the elected government, but it absolutely needs day-to-day operational freedom to do its highly technical job without constant political interference.
Okay, we're in the home stretch now. Let's do a specific PYQ lightning round. I'm going to throw a few concepts at you that have frequently appeared in the UPSC exams, and you give me the quick expert synthesis.
Sounds good. I'm ready.
First up, inflation control. This was in PYQ in 2015. Who is ultimately responsible?
Well, ideally, it's a joint effort. But this specific PYQ answer focuses clearly on the RBI. The RBI controls the monetary side, managing the money supply. The government controls the fiscal side, fixing supply chains or adjusting taxes. But under the new MPC framework, the primary statutory legal mandate for inflation targeting lies squarely with the RBI. So if the exam asks who is primarily responsible for maintaining price stability, the definitive answer is the Reserve Bank of India.
Perfect. Next, hard versus soft currency. Why does the RBI hold massive amounts of US dollars and not just our own rupees in its foreign reserves?
Because the US dollar is a hard currency, it is universally accepted, globally trusted, and highly stable. The Indian rupee is considered a soft currency. It is not yet fully globally convertible or accepted everywhere for trade. Foreign reserves are kept specifically for emergencies. If India is in an economic crisis, you need assets that the rest of the world actually wants to accept. You can't pay Saudi Arabia for oil imports in rupees during a major crisis if the world loses faith in the rupee. You absolutely need dollars.
Makes complete sense. Last one, sterilization. We touched on this briefly, but let's define it really clearly because this term confuses everyone I talk to.
It does, but just think of it as a massive macro-level cleaning up operation. Imagine foreign investors suddenly dump billions of dollars into India to buy our stocks. The RBI has to step in and buy those incoming dollars to stop the rupee from appreciating too wildly.
But when the RBI buys those dollars, it has to pay the sellers in rupees. So it essentially prints or digitally creates new rupees to buy the dollar.
Right. So suddenly, because of that foreign investment, there's a massive flood of brand new rupees in the domestic market. That excess liquidity will inevitably cause inflation. So the RBI immediately does a second step. It sells government bonds through FOMO to suck those exact same rupees right back out of the banking system.
Oh, it neutralizes its own impact.
Exactly. Buying the dollars releases domestic liquidity. Selling the bonds absorbs that exact same domestic liquidity. The net effect on the domestic money supply is zero. That entire two-step dance is called sterilization. It keeps the domestic money supply perfectly stable despite massive foreign inflows or outflows.
Brilliant. That makes it crystal clear.
It really highlights the insane daily balancing act the RBI performs.
So bringing this all together, what is the ultimate... So what here? We've talked for an hour about levers and pulleys committees, reverse repos and reserves.
The overarching... So what is that? The RBI isn't just a bank. It is the ultimate guardian of India's macroeconomic stability. It constantly faces what economists famously call the impossible trinity. The theory states you cannot simultaneously have three things. 1, a fixed, stable exchange rate. 2, an open capital account, meaning free flow of foreign money in and out. And 3, an independent monetary policy to control domestic interest rates.
You can only pick two at any given time.
Exactly. And India tries to skillfully manage the messy middle ground. We have a managed float, so it's not fixed, but it's not totally free. We have a mostly open capital account, but with strategic restrictions. And we fiercely try to keep our monetary policy independent. It is a constant high-stakes juggling act. And the RBI is the master juggler, keeping all these conflicting macroeconomic balls in the air so the broader economy doesn't crash.
And as we've learned today, the tools they use, the CRR, the repo rate, the open market operations, those are the actual balls they are juggling.
Indeed they are. And mastering how those tools interact is the key to mastering the Indian economy syllabus.
Well, this has been a truly phenomenal deep dive. Just to briefly recap for our listeners, today's insights were meticulously constructed from Sanjeev Verma's Indian Economy Chapter 14 and Vivek Singh's Indian Economy Chapters 2 and 3.
2 absolutely essential reads for anyone serious about cracking this topic.
And before we sign off, a final reminder from our partners. If this deep dive helped clarify the complex machinery of the RBI for you, please subscribe to the Simplified UPSC by PPP YouTube channel. It's the absolute best way to catch the next analysis.
And if you are financially capable, please support the team on Patreon. It goes a really long way in keeping these in-depth deep dives free and high quality for everyone.
Don't forget to join the Telegram channel for the free notes and PYQ linkages we discussed today. And for the serious mains learners out there, check out that private library for the premium content and model answers. DM on the public channel to join.
Keep learning, everyone, and stay curious.
And I'll leave you with this final thought as we look toward the future with things like the digital rupee and central bank digital currencies. Money is only as valuable as the system that manages it. Thanks for listening.